won't see a short-lived type of rally. So far, we've seen a pretty good sustained rally in the past, and they tend to last for over a year. So we've been through 6 months of this now, right? So there's probably more to run, a year and a half.
So what is your estimate for the highest level that Hang Seng Index will reach within this year?
We have a year-end target of 24,500 points, which is not too far from where we are. I guess that reflects our view that we are cautiously optimistic.
Since 2024, every rebound of the Hong Kong stock market has shown a trend of rapid increase and followed by a decline. So moreover, the stocks with good performance are concentrated in a few industry or even individual shares. So do you think the Hong Kong stock market is suffering from a lack of momentum?
We have suffered from lack of momentum in the past. I think things have changed this year. So we have the AI theme at the beginning of the year. We also have the weak dollar situation. And subsequently, we have a lower interest rate in terms of HIBOR in Hong Kong as well. Southbound have been strong into the Hong Kong market. So I think from a flow perspective, we have been more positive this year and seems to be more sustainable this year versus the last couple of years. So we are optimistic that we won't see a short-lived type of rally. So far, we've seen a pretty good sustained rally, and it feels like the flow still comes in. And it's partly supported by the IPOs that we have.
So it is said that the Hong Kong stock market has faced with the contradiction of abundant liquidity and shortage of attractive assets. So how do you think the investors can balance their pursuits of stable returns and growth returns in such an environment?
Yeah, so the liquidity situation in Hong Kong has improved. We are running over 200 billion a day in trading volume, which is a lot better than we've had in the last 2-3 years. So from a liquidity perspective, it's much better. And Hong Kong does have the range of stocks that, for example, the A-share market doesn't have. For example, the internet space. Hong Kong is also attractive from a dividend yield perspective. So Hong Kong is unique in offering those themes that investors can participate. And that's why we're seeing increase in southbound flow to buy internet names, to buy the AI theme, to buy particularly insurance company buying dividend in Hong Kong as well.
So the Hong Kong stock market has long been characterized by a high proportion of foreign and institutional holdings. So how do you think foreign investors will deploy their capital across different sectors of Hong Kong stock market in the next 6 months?
Yeah, so I think it's ultimately back to fundamentals, right? Just the sectors that are delivering earnings growth, for example, the internet sector, and it's also around the themes of AI and adoption and monetization. So we think from a growth perspective, internet does offer those characteristics. But also I think it depends on the requirements of the investors themselves, right? So Hong Kong does have both growth and value. Value, i.e., in terms of dividend. In the dividend space, it's also attractive, right? Some of these dividend names are yielding 5%, 6%, 7% dividend yields. So I think we've been advising investors to be barbell. So we have, on the one hand, defensive names, and on the other hand, a higher base of names, just to capture the range of outcomes in macro and the trade situation.
So do you think will their attitude towards holding Hong Kong stocks change in the future?
Well, the attitude would depend on the fundamental of the companies that are listed. And in the next 6 months, let's say, we don't see a lot in the way of material changes. Again, like we said, the macro environment seems to have stabilized. And we are seeing a lot of IPOs that's supporting sentiments in Hong Kong. There's a lot of liquidity in domestic Hong Kong as well. So HIBOR rates have collapsed from 4% to now well below 1%. that may release some capital into the stock market or even the property market. So we see catalysts supporting the rally that we've seen so far.
And let's talk about the China's southbound funds. So the Hong Kong stock market has risen by over 20% this year, with mainland Chinese southbound funds becoming an important participant. So the stocks with a high proportion of southbound fund holdings are mostly dual-listed A+H shares, and mainly concentrated in sectors such as healthcare, industry, and finance. So what is the underlying logic for investors in choosing these sectors?
Well, the logic is, firstly, the H tends to be a bit cheaper than the A. And secondly, the H market also offers probably better dividend yield than the A share market. Lastly, the H market is somewhat more attractive just from a geopolitical improvement perspective. Foreign investors tend to buy the H shares a lot more easier than the A share. So based on that, those three reasons, I think the H share is still attractive. And that AHA premium could narrow as more AUM chases, particularly dividend, right? So insurance companies are getting new AUM and they are buying the dividend names in Hong Kong.
The premium of China's A shares over H shares has narrowed to 27%, which was a 5-year low. So with some popular stocks even seeing their A share prices lower than their H share price, so how do you think about this?
Reflects just a better your flow of capital in Hong Kong. And I think recently the depreciation of the USD did bring in a lot of HAD, right? So Hong Kong dollar asset became more attractive. This fund flows into Hong Kong, which is bidding the H market higher. And that seemed to be continuing, right? Like we said, the HIBOR went from 4% to 50 bips, 60 bips. That will trigger a lot of the time deposits seeking yield related stocks or in other risk assets like property. So that flow will continue to drive the Hong Kong market and sustain that narrower AH premium.
Do you think that the situation of A shares over H shares gives any implications to the investors?
Yeah, it depends on where you're located. Yeah, we still prefer the H share despite the narrowing of the AH premium. The H offers something that's different, I think, to the A. Like we highlighted, the internet space is a case in point where the stocks are listed in Hong Kong, right? And to access that growth, which they are delivering, right? So we just had a relatively good earnings season amongst the internet names. So that's the only place where you can access. But also, for example, the financials, to the extent there are good dividend yield, that yield gap is also interesting, right? So we have good dividend yield in Hong Kong.
So let's just go back to the southbound funds, okay? So what is your view on the allocation of southbound funds to Hong Kong stock market sectors?
Quite concentrated, like internet, financials, yes. Some of the yield names, and kind of new consumer has been talked about and has been performing very well. So I would say a relatively narrow set of stocks, mainly mainland Chinese stocks, as opposed to Hong Kong domestic, and the large cap names.
Yes, so you've also mentioned that the new consumer sectors, and I'd like to ask, so currently technology and consumer sectors have already accounted for half of the Hong Kong stock market. So what impact do you think the structural change has had on the growth of potential and valuation system of the Hong Kong stock market?
Yeah, so to the extent they are high multiple businesses and industries, then the index should re-rate, right? So at the moment we are still slightly below mean multiple. The HSI is on about 11 times price to earnings, which is still slightly below mean. So to the extent these stocks, the mix of these stocks increases over time, then we should see the index re-rating to a higher multiple.
The low valuation of Hong Kong stock market has long been considered as its norm. Do you think it is possible to break its low value situation status in the future?
I think so. We are seeing, I think the multiple has been kept low because of many factors, interest rate being one, right, in the US. So Fed rates have obviously been through an upcycle, and to the extent it comes down gradually, then there will be re-rating upside. And secondly, I think it flows from DM back to EM with the interest rate being lower, and that probably attracts some flow back to Hong Kong, China, and then regionally, to the extent flow have moved to places like India and Japan, and those flow could come back potentially with a lower rate. So all in all, there will be some flow factors into Hong Kong that will support the valuation. And I think from a relative valuation perspective, Hong Kong is still quite cheap. Absolute basis, we are again slightly below mean, so we're close to mean multiple. But relative to particularly the US, Hong Kong is still a very cheap market. Now, if the fundamental improves, which again ties to China macro, ties to the trade war, assuming a benign picture, then we should see some re-rating potential.
Yes, so I still want to know that how long will the revaluation recovery take, and how great is the potential? Like, do you have any?
Yeah, so if we just look at, let's say, the AI themes or technology themes in the past, I mean, they tend to last for over a year. So we've been through 6 months of this now, right? So there's probably more to run, a year and a half. So again, it's all the geopolitics, let's assume is stable, and things seem to be trending well at the moment. Then investors will focus on these themes, and those themes will carry the index higher and sustain that valuation. So we are again cautiously optimistic as a result. And as more IPOs and high value industry leaders get listed in Hong Kong, we should see that index also supporting index valuation as well.
What are the unique advantages of Hong Kong stock market?
Yeah, so unique access to certain stocks, high dividend names. Hong Kong does have a range of stocks that have those characteristics. I think being a market where we can attract foreign capital more easily, that's also important. So all this IPO listing, that was on the back of policies a year ago. So those are helping the Hong Kong market. So those are broadly the unique characteristics that we have. And I think domestically as well, don't forget we have around 10 trillion Hong Kong dollars of time deposits. Now with rates being so low now in Hong Kong, some of those flow or some of those time deposit might flow into the market, equity markets or property markets. So that offers support to the Hong Kong equity market as well.